Welcome to the Opening Bell Report.
I want to start today with a number that, frankly, just shouldn't exist in the hardware world. 154%.
Yeah, that's a number you usually associate with a viral app. Or maybe a biotech startup that just struck gold.
Right. Not a company moving massive metal boxes.
Definitely not.
But that's the thing. We aren't talking about user acquisition numbers or, clicks. We are talking about sequential revenue growth, quarter over quarter.
Which is the critical distinction here.
Exactly. I mean, if a company tells me they grew 154% year over year, I'm impressed, sure.
Yeah, it's a great year.
But if they tell me they grew 154% sequentially, meaning they basically more than doubled their entire business operation in 90 days.
You're usually looking for the accounting here.
Right. I'm assuming they made a massive acquisition or something.
But in this case, it's entirely organic.
It is organic, and it is pretty violent. Welcome back to the Deep Dive. Today we are unpacking a really fascinating source, the SMCI AI Infrastructure Growth Report from Q2 2026.
And the subject is, of course, Supermicrocomputer Inc.
SMCI.
Right.
So for you listening, our mission today isn't just to gawk at stock prices. We want to really dissect how a company physically doubles its business in 3 months.
Yeah, the logistics alone are wild.
And we need to figure out if this is officially the fastest growing tech stock of the cycle. And crucially, and this is a big part of the analysis report, is the market getting the valuation completely wrong?
Because the report frames this not just as a good quarter, it's a metamorphosis.
Right.
We're seeing a legacy server manufacturer suddenly posting numbers that make high-flying FOSS companies look, well, stagnant.
It really forces a recalibration of how we think about tech.
It does. The market has spent the last decade valuing software because, it scales infinitely with zero marginal cost.
You just sell another license.
Exactly. But SMCI is proving that hardware, if it's the exact right hardware, can scale with similar velocity, even if the physics are much, much harder.
So let's get into the physics and the plumbing in a bit. But first, let's just stick to the velocity of the numbers.
Let's do it.
I want to really ground this for you, the listener, because percentages can kind of hide the sheer scale of what happened here. Let's look at the raw dollars from the report.
Yeah, the absolute dollar figures are where it gets real.
So Q1 of 2026, SMCI posts a revenue of $5.0 billion.
Okay.
Now, $5 billion is a serious business. You are a major player at $5 billion a quarter.
Oh, absolutely. That's Fortune 500 territory right there, just on a quarterly basis.
Right. Then Q2 2026 happens.
The jump.
Revenue jumps to $12.68 billion.
Which is a $7.6 billion increase in 90 days.
Just to contextualize that delta, they added more revenue in 3 months than many S&P 500 companies make in a whole decade.
Yeah.
It's insane.
And this is where that sequential metric we mentioned becomes way more important than the year-over-year metric.
Right, because the report notes year-over-year growth is sitting at positive 123%.
Which is huge. But the sequential growth is positive 154%.
Right.
When your sequential growth outpaces your annual growth, you are basically in the middle of a vertical acceleration event.
A rocket ship.
Basically, yeah. You're effectively a completely different company at the end of the quarter than you were at the start.
And the report mentions they've even raised their full-year guidance.
Right, to a minimum of $40 billion.
$40 billion, which implies they believe they can hold this plateau.
Exactly. They aren't treating the $12 billion quarter as some freak fluke. They see it as the new baseline.
But I want to push on the operational reality of this. Like we said earlier, if I'm a software company, doubling revenue usually just means my AWS bill goes up a bit.
Yeah, you don't have to build a factory.
Exactly. But SMCI deals in atoms. They deal in metal and silicon.
And that is the ultimate constraint.
To go from $5 billion to nearly $13 billion means sourcing twice the chassis, twice the motherboards, twice the power supply units.
It means twice the trucks leaving the loading docks every single day.
The logistics of that alone are staggering.
It honestly borders on a manufacturing miracle. You really have to understand the supply chain friction here.
Tell me about it.
Well, these aren't generic commodity servers anymore. We're talking about highly complex AI clusters. To ramp production that aggressively suggests one of two things.
Okay.
Either they had a massive amount of capacity lying dormant, which is unlikely, or they are running their lines 24/7 at absolute breakneck speeds.
The report definitely leans toward the latter.
Yeah, and it also suggests they have incredible leverage over their suppliers. You don't just get that many specialized components on short notice unless you are the absolute priority customer.
Which is a perfect segue into the why. The analysis report calls this next section the anatomy of an explosion.
I love that title.
Right. It's not just that, AI is popular. The report details a massive structural shift happening inside the data center.
Yeah, and we need to be very specific about what structural shift actually means here.
Break it down.
So for 20 years, the data center was totally defined by the CPU. Intel was king.
Right.
You bought rows of generic servers, you virtualized them, and you ran your databases and your web apps. That was the cloud era.
Right, exactly, the cloud era.
But now we are fully in the AI industrialization era. The data center is essentially being ripped out to the studs and replaced.
Because the CPU is secondary now.
Exactly. The GPU is the primary asset. And you can't just shove an H100 or a new Blackwell chip into some old Dell box and hope for the best.
The report uses this picks and shovels analogy, which, I usually find a bit cliche in tech analysis.
It is overused.
It is, but in this case it feels accurate. Except they aren't just selling shovels. They are selling heavy industrial drilling equipment for the AI gold rush.
That's a great way to put it. It's a pure infrastructure build-out.
But why SMCI? Why are they capturing this specific 154% growth while the legacy competitors are growing much, much slower?
The analysis identifies two main drivers for that strategic advantage: speed and heat.
Let's start with speed. The report heavily highlights their NVIDIA partnership.
Yeah. In this current cycle, time to market is literally the only metric that matters for these mega cap customers.
Because they're in an arms race.
Exactly. If you are training a foundational AI model, every single week you wait for hardware is a week your competitor gets ahead. It's an existential threat.
So how does SMCI move faster?
Well, their defining characteristic has always been their modular architecture.
They basically treat servers like Legos.
That's exactly it. They don't design one massive monolithic box. They design individual subsystems that can be swapped out.
Oh, I see.
So when NVIDIA releases a brand new, highly anticipated chip, SMCI doesn't have to go back to the drawing board and redesign the whole chassis.
They just swap the new module in.
Exactly. This allows them to ship these complex, custom-built AI server racks months before the big legacy titans can even spin up their supply chains.
So they are basically speedboats in a sea of ocean liners?
A speedboat carrying a massive, massive amount of cargo, yes.
Okay, so that's the speed. Now, the second driver, the heat.
Ah, yes.
The report gets very specific about SMCI's proprietary liquid cooling technology.
This is really the aha moment in the report for the engineering craft.
Explain this to me because, data centers have been air-cooled for decades.
Right.
Giant air conditioners, raised floors, hot aisles, cold aisles. Why does the report say liquid cooling is suddenly a, quote, mandatory requirement?
It all comes down to basic physics. Air is actually a terrible conductor of heat.
Okay.
But it was cheap and it was easy, so we used it. However, we've now hit a density wall with these AI chips.
How hot are we talking?
The thermal design power, the TDP of these next-generation GPUs, is pushing 700 watts. Some are even hitting 1,000 watts per single chip.
1,000 watts. That's literally a space heater.
It is a hairdryer running at full blast, concentrated into a piece of silicon the size of a drink coaster.
Wow.
And remember, you have 8 of those in a single server, and you have up to 40 servers in a single rack.
That's terrifying.
If you try to cool that much concentrated heat with air, you need fans spinning so fast that they literally vibrate the building.
Not to mention the power bill.
Oh, yeah. You end up spending 40% of your massive electricity bill just on air conditioning.
So air cooling is just wildly inefficient now.
It's not just inefficient. The report notes it's becoming physically impossible at a certain density.
Because of the latency.
Yes. To get the performance AI models need, you have to pack these chips as close together as physically possible to reduce the latency of the data traveling between them.
And when you pack them that tight, the air physically cannot flow through.
Exactly. Air doesn't work. You absolutely need liquid. Liquid is thousands of times more efficient at heat transfer than air.
So the report suggests SMCI has a massive moat here, but I have to play devil's advocate.
Go for it.
Isn't liquid cooling basically just plumbing? I mean, can't anyone do it?
You would think so, but it's incredibly non-trivial.
Oh.
We're talking about direct-to-chip cooling, DTC. You are running physical coolant lines directly onto the silicon inside a high-voltage server inside a mission-critical data center.
Ah.
Water and electricity.
Exactly. A single micro leak destroys a $200,000 system instantly.
Ouch.
Yeah. And SMCI has been building these coolant distribution units and the complex manifolds for years, back when everyone in the industry said it was totally overkill.
So they were prepping for a future that hadn't quite arrived yet.
And now that the future is here, and it's incredibly hot, they are essentially the only ones with a reliable mass production solution ready to deploy at scale.
That's why they're winning these $12 billion quarters.
Exactly. They aren't just selling a server, they are selling the entire thermal envelope that allows the server to even run in the first place.
Okay, so we have a company doubling its size in a quarter, holding the keys to the thermal kingdom, and guiding for $40 billion in annual revenue.
Right.
You would naturally assume the stock is trading at some stratospheric valuation.
You really would assume that. But this leads us to the valuation mystery segment of the analysis. because the report points out a massive glaring disconnect.
Yeah, the multiples are fascinating here.
The report states the current PE ratio is around 24.7x, but the forward PE ratio is hovering around 13.2x.
Which, for anyone listening who is familiar with tech valuations, is deeply confusing.
It really is. A 13x forward multiple is what you pay for a utility company or a regional bank.
Or declining legacy manufacturer.
Right. If a standard SaaS software company grows at 30%, the market easily gives it a 50x multiple.
Without blinking.
But SMCI grows at 154% and gets a 13x multiple. The report explicitly calls this a compressed valuation.
Yeah.
Why does Wall Street seem to hate this stock?
Well, they don't hate it. They just don't trust it.
What do you mean?
There is a deep-seated bias in the financial markets against hardware. It's what analysts often call the hardware discount.
Oh, because of the PC era.
Exactly. Investors have muscle memory from the PC era and the early server boom. They remember that hardware almost always eventually becomes a commodity.
Right. Margins get crushed as competitors flood the market.
Yes. It inevitably becomes a race to the bottom on price. So the market looks at SMCI and asks, is this truly a tech company? Or is it just a factory bending metal in a lucky cycle?
But the report argues heavily that this is a fundamental mistake.
It does.
It points out that AI infrastructure now comprises over 90% of SMCI's entire business. It argues this isn't a typical commodity cycle. It's a highly specialized industrialization phase.
And that is the ultimate bull case presented in the report. The argument is that SMCI isn't Dell in 2005. It's functioning more like an arms dealer.
Or a specialized construction firm for the new digital age.
Precisely. But the broader market is pricing in a massive sudden deceleration. A forward PE of 13 strongly implies that investors think this current earnings boom is just a one-time sugar high.
I think it's going to crash back down to earth next year.
Yeah. Cyclicality. The underlying fear is that once Microsoft and Meta and Google buy all the AI servers they need, demand just falls off a cliff.
But the analysis counters that.
It does. The report counters by stating, we are only in the very first inning of a multi-year global build-out.
So the valuation gap exists purely because of that lingering skepticism.
Exactly.
So the real opportunity here, according to the analysis, is the arbitrage between that legacy hardware perception and the AI industrial giant reality.
Yeah. If the market is wrong, and SMCI actually maintains this level of growth, the multiple expansion combined with the sheer earnings growth would be absolutely explosive.
The report actually calls it a, quote, generational entry point.
It does.
However, and we need to be responsible here, we absolutely have to look at the growing pains section of the report.
Yes, very important.
Because you cannot grow your operations by 154% in 90 days without something catching fire, metaphorically or literally.
Honestly, this is the part of the report that I think is the most critical for you listening to truly understand. Growth consumes cash.
Wait, explain that mechanism, because if they're selling $12 billion worth of product, aren't they just swimming in cash?
Not necessarily. It's all about the cash conversion cycle.
Okay, walk me through it.
Think about the timeline. To build a $50,000 liquid-cooled server rack, SMCI first has to buy the NVIDIA chips, the memory, the copper, the steel.
Right.
They have to pay their suppliers for all of that, often upfront or within 30 days.
Okay.
Then they have to physically assemble it, test it, ship it, and finally invoice the customer.
And the customer doesn't pay immediately.
Exactly. The hyperscaler customer might not pay that invoice for 60 or 90 days.
So there is a massive time gap where the cash is gone.
A huge gap. And when your volume is growing by 154%, that gap becomes a chasm.
Oh, I see.
You have to lay out billions and billions of dollars for inventory today to fulfill orders that won't actually pay you back for 3 months.
Wow.
The report heavily flags this capital intensity as a major risk factor. A company in this situation could technically run out of cash, even while being wildly profitable on paper.
That's what they call the working capital squeeze.
Precisely. In fact, the report notes they recently had to raise capital just to fund this massive inventory buildup.
And if there's a supply chain hiccup?
That's the nightmare scenario. If they buy $10 billion worth of GPUs, but they can't ship the finished servers because they're waiting on a $2 custom cable.
All that capital is just trapped on the factory floor.
Trapped. Exactly.
The report also spends time on logistics and margin stabilization.
Yeah, you can definitely see the strain in their gross margins. When you are rushing to meet infinite demand, you pay for expedited air freight instead of standard ocean shipping.
You pay massive overtime to the assembly line workers.
You pay spot prices for scarce components. The report notes they urgently need to, quote, streamline manufacturing and stabilize margins.
Basically, they are sprinting a marathon right now.
That's exactly what it is. And their form is getting a little bit sloppy because they are just desperately trying to cross the finish line and deliver the hardware.
So the core risk isn't that nobody wants the product.
No, demand is infinite right now.
The risk is that The machine itself breaks under its own speed.
It's pure execution risk. Can the current management team effectively operate a $40 billion global company? Because running a $5 billion company is a completely different sport.
Right. But despite all these risks, the intense cash burn, the logistical chaos, the report ultimately concludes that SMCI is sitting at the absolute epicenter of the AI revolution.
It's hard to argue with their physical positioning. They are the bottleneck.
The toll booth.
Yeah. If you want AI, you need a GPU.
Yeah.
If you have a dense cluster of GPUs, you need a liquid-cooled rack. SMCI is the toll booth you have to pass through to get it.
So let's zoom out a bit to wrap this up.
Okay.
We've dissected the massive $12 billion quarter. We talked about the liquid cooling technology necessity and that confusingly low 13x valuation multiple. For you listening who might not be going out to buy the stock today, but really wants to understand the shifting tech landscape, what is the grand synthesis here from the report?
The synthesis is that the fundamental balance of power in Silicon Valley is shifting.
Shifting how exactly?
Well, for the last 15 years, the mantra was software ate the world.
Mark Andreessen.
Right. The code was king. The hardware was just a dumb commoditized pipe that the code ran on.
But AI has reversed the polarity.
Completely reversed it. The constraints on AI aren't software anymore. The algorithms are out there. The constraints are entirely physical.
Power.
Cooling. Supply chain availability of specialized chips.
The atoms are striking back against the bits.
In a way, yeah. The real value is flowing back down the tech stack to the heavy infrastructure layer. And this report on SMCI is basically the perfect case study of this shift.
It really is.
We are seeing a hardware company, a business that literally deals in sheet metal, copper tubing, and liquid coolant posting growth rates that would make a premier software VC absolutely drool.
Because without that sheet metal and without that coolant, the AI literally does not work. It melts.
Correct. The digital mind needs a physical body to exist in. And building that physical body is turning out to be way more lucrative and way more difficult than anyone in the software era expected.
I really love that phrasing. I want to leave you, the listener, with a final thought today, building on that massive valuation disconnect we talked about.
Yeah, the multiple.
Right. We have a public market that flat out refuses to give a hardware company a premium valuation, despite them posting 154% sequential growth.
Because of that muscle memory.
Exactly. The market is betting that physics is just a commodity. They're betting that eventually building these complex, liquid-cooled supercomputing racks will become as cheap and easy as making a toaster.
That is the bet Wall Street is making.
But what if it's not? What if the advanced engineering required to cool the next generation of 1,000-watt chips is so incredibly hard and so capital-intensive that it never actually becomes a commodity?
Well, if that's true, then the hardware makers aren't the janitors of the AI age anymore.
No.
They're the landlords.
And right now, the landlord is definitely charging rent.
Big time.
Thanks for diving deep into the infrastructure with us today.
See you next time.
Don't forget to like, share, and subscribe for more.